Regulation. Our next guest finds himself at the very center of it, and one of the biggest issues on Capitol Hill is crypto regulation. Our next guest finds himself at the very center of it, and joining us right now is Brian Armstrong. He's the co-founder and CEO of Coinbase, of course, the largest U.S. crypto exchange and a global crypto powerhouse. You made a big move in Washington that, by the way, everybody here in Switzerland is talking about as well, as it relates to this effort to create some kind of regulation framework around crypto. Tell us what happened exactly last week.
Yeah, so last year we got the Genius Act passed. That was a great piece of legislation for crypto. And now what everyone's working on is called market structure, right, the non-stablecoin crypto assets. And there's been a ton of hard work. You know, the Senate has been amazing to work with. There's a lot of constituents coming in to offer their opinion, including the crypto industry. And of course, Coinbase has a point of view, although we don't represent the crypto industry. And we saw some draft text midnight on Monday night.
Right.
Our lawyers started looking at it on Tuesday. I was in D.C. on Wednesday. We started to notice some pretty serious issues in the draft text that we had a concern with, and there didn't appear to be a plan to actually get that fixed coming out of a Senate Banking Committee markup. And so we actually felt like we had an obligation to go out and defend our customers' rights and say, we have some issues here. We were careful not to comment on what the Senate should do in terms of markup or not, but they did decide to postpone it, and so now there's an opportunity for us to come back and chat with the bank CEOs and see what would create a win-win outcome here.
So let's walk through some of those issues and also walk through what is a battle taking place between crypto and maybe classic legacy Wall Street here. Mm-hmm. And then maybe we get into also just the power and influence that you have, whether you believe you have it or not, because every headline last week about this very bill effectively getting temporarily suspended, or at least was about the withdrawal of support that from you, effectively. Mm-hmm. So you do have more influence maybe than you think. But let's talk about the issues themselves first. Top 3 issues right now for you that were problematic in that bill.
Yeah, so the number one is really around payment of rewards on stablecoins. I think Americans should be able to earn more money on their money. Banks should have to compete on a level playing field, and if the American people feel like the banks are not paying high enough interest rates and stablecoin rewards can offer them more, then maybe the banks should have to pay higher interest rates to compete, right? I don't think there should be any protectionism.
Do you think that was put in directly for the banks, that was lobbied by the banks and put in?
Yes.
And look, the banks argue effectively that the stablecoin market is going to force massive withdrawals that are going to come out of the banks, that it is not an efficient system for credit in America, effectively, because the treasuries that are going to be required to back the stablecoins are not going to be used in the same way. I mean, there are arguments that because the treasuries that are going to be required to back the stablecoin market is going to force
lobbied by the banks and put in?
Yes. And look, the banks argue effectively that the stablecoin market is going to force massive withdrawals that are going to come out of the banks, that it is not an efficient system for credit in America, effectively, because the treasuries that are going to be required to back the stablecoins are not going to be used in the same way. I mean, there are arguments that I think have some validity from the banking system beyond what you think ultimately happens to the banking system and how much you care about the strength or not of it.
Yeah. Well, there is certainly a balance of where should this capital go. I mean, it can go to lending, which is important. It can also go to buying U.S. treasuries, which is also important. And I think that it's essentially going to come down to where can people earn return for the appropriate amount of risk, right? If the Fed lowers interest rates, that would push more people to seeking higher returns from a lending product, right? If they raise interest rates, it's going to keep more money at the Fed. And that's frankly what a lot of banks are doing. They're holding trillions of dollars at the Fed also that's not being lent out. And so I think what we have to realize here is that crypto can provide solutions like rewards and stablecoins. It can also build lending products. Like DeFi lending is growing enormously. Banks can provide that also. And so we should have a level playing field where everyone can compete, right, clear rules, and everyone can win.
Should you have a level regulatory framework as well? Should you be regulated the very same way the banks are, if that's the plan?
Well, the banks are doing something very different, which is called fractional reserve lending. So they're actually lending out customer deposits without their permission, essentially, right, to earn the spread. And that's what the whole banking, that's why there's such heavy oversight from banking regulation.
What's different in what you're planning on doing with your customers' assets?
So under Genius, stablecoin issuers have to hold 100% reserve. It's not fractional reserve. 100% of the assets are in short-term U.S. treasuries. It's very low risk. It's less risky than holding it in a bank.
The DeFi lending would be coming from what money?
That's customers opting into it. And they can say, all right, I actually want to earn more, so I'm going to put my money into this DeFi protocol, and I can get 6 or 7 or 10% return for some appropriate amount of risk. So it's customers opting into it as opposed to banks doing it behind the scenes.
I don't know if you had an opportunity in our green room is Brian Moynihan, who's coming on right after.
Oh, yeah.
Did you guys have an opportunity to talk? Have you been talking to a lot of the bank leaders here about this very issue? Because I assume he has some pretty, provocative things to
I had
say.
to separate those two. It was
You had to separate them.
Brian played rugby in college. Maybe
I think David Beckham's in there.
and David
Yeah, David
Beckham's in there
Beckham's
on Brian.
You've got an
Moynihan's.
all-star cast in there, but no, actually, I have been here meeting with bank CEOs. That's one of the main things I'm doing is trying to figure out, okay, what would get them to a yes? I do believe there's a win-win outcome. I mean, by the way, Coinbase is actually providing crypto infrastructure services to 5 of the top 20 banks in the world. And so we're talking with the commercial sides of these banks, and they see it as an opportunity. Their lobbying arms and their trade groups are coming in and trying to ban their competition. And so to me, you shouldn't be able to ban competition.
What do you make of the larger credit piece, though? Because there's a sort of, I don't know, it's philosophical or practical, just about credit in America and treasuries themselves. Because by default, if you actually have to own the treasuries in full to back the stable coins, you're effectively taking them out of the marketplace to be lent in a different way.
Well, this is the same thing that money market funds do, right? It's when banks are holding their reserves overnight at the Fed, that's exactly what they're doing. So this already exists. It has nothing to do with crypto, actually. It's been there for a long time. And there's a lot of deposits that are very interest rate insensitive, right? So in my view, if this legislation goes through, there's going to continue to be that balance with banks and crypto companies. Where can customers earn the best rates and rewards? They're going to choose to put it in lending or in something that is linked to short-term treasuries.
New York Stock Exchange just announced yesterday a new platform that I imagine will compete with you to some degree, a new tokenized platform. Everybody seems to be introducing all sorts of programs that frankly look a lot like things that Coinbase does. And I wonder just what you think the whole industry looks like, a year or 2 or 3 from now in terms of what you're doing relative to what everyone's doing. And by the way, at the same time that you're trying to get into everybody else's business.
Yeah. Well, I mean, I was thrilled to see that. I think New York Stock Exchange announcing their interest in tokenized equities is just one more data point of the crypto is updating the financial system, and we want everyone to be able to do that and make our capital markets more efficient.
But does it take the moat away from everybody's business? If everybody can do the same thing, what happens in the end?
Customers win with competition. I mean, we shouldn't have policies being created in the United States that favor one set of companies over another. There should be clear rules of what's allowed, what's not, and then everyone competes. That's how the customer benefits.
I didn't even know about this. Quick read. The NYSE, New York Stock Exchange, turns to tokenization to extend Wall Street beyond market hours. The platform plans to enable fractional share trading via dollar-denominated order sizes, ICE. What the fuck is that? Integrate token. What is ICE? I don't even know what that means. Collaborating with banks such as BNY Mellon and Citi to integrate tokenized deposits. What is ICE? The New York Stock Exchange tokenization securities platform that will enable 24/7 trading in U.S. listed equities and ETFs with on-chain settlement and immediate funding. Yeah, man, this shit's happening. It's happening. I'm gonna drop my Coinbase link in the description, man. Y'all keep up, catch up, stay up. Yeah.